Well, we were mentioning after a big run-up for stocks, we've started to see some cracks in tech this week. And yet, when it comes to the end of the year, the big question is whether investors will truly lean away from these sectors that have driven equities to all-time high, especially when you have some well-known strategists on Wall Street who are still fairly constructive on the stock market. That includes our next guest, Scott Chronert, who is a U.S. equity strategist for Citi. Citi just raised their expectations for the S&P heading into the end of the year. Scott, it's great to have you with us. Appreciate your time.
John, great being here. Thank you.
It's it's been an interesting market to track these last few months, and not a lot that breaks investors away from their bullish attitude. Let's just start with your current thinking on the market. You know, we're taking a pause here in late summer, getting ready for the fall. You guys have reassessed as well. What did you come up with?
Yeah, so I think the way we're talking about it is that you can't ignore the fundamental tailwinds to this mega cap growth cohort that's affected by the AI spending tailwinds, okay? Our work is that this is accounting for roughly half of the S&P 500 market capitalization. So what that means is that you've had this big ongoing influence that's been supported by the fundamentals in terms of the CapEx spend and other spending initiatives around building out AI capabilities, okay? At the same time, you've got, let's call it the other half of the market that's going to be more attuned to traditional macro influences. And here's where, we think you have to begin to talk about a broadening dynamic as we go into the end of this year and into 2026. This is where the interest rate trajectory, underlying state of the U.S. economy and global economy comes into play. So call it a tale of two parallel markets going on right now. This tech part has had a massive run off of the April post-Liberation Day lows. It's due for a pause. Got that? We kind of consider this sort of a pause that would refresh as long as the fundamentals continue very much intact, and they sure seem to be pointing that way at this point, John.
Yeah, that's really helpful. I like that idea. Parallel paths makes a lot of sense. I just, for interest's sake, I just went back and looked at what the S&P performance has been since the start of 2023, because we had that great couple of years of performance. People weren't sure about this year. The momentum continues, but it is so lopsided towards those sectors that scream tech. And then you've got other parts of the market that haven't had as robust returns. As you talk about these two parallel paths, I guess my question is, do you have to pick one as an investor under the hood, or do you just have to understand those dynamics?
Well, you can, right? You can go down the growth versus value path, or you can go down the sector path. But for many investors that are just in or out of the market, you're sort of making a decision that the S&P 500 in the U.S. case is going to reflect this combined trend. But, we talk about broadening through a number of different lenses. As I mentioned, the sector approach. You can even talk about going more globally in terms of your reach. And then in the U.S., you can even go down cap into small mid cap, which has lagged over the past couple of years, is more attentive to the underlying economic condition, should benefit at the end of the day from lower Fed rates and so forth. So you do have options in terms of how you want to participate from this point going forward. But I say for most investors that are looking straight down, the center of the lane here with the S&P 500 is just be prepared that there's going to be some volatility when you've had the type of move we've had in the past 3 to 4 months. You have to expect a digestion phase, and it's going to come down to how fundamentals are unfolding. And we think that we're in a broadening fundamental mode going into next year that should support the performance broadening as well.
So, one of the interesting things, look, we cover the markets every day. There are ups and downs in the short term, but then there are so many people that just want to be well positioned for the long term. So I mentioned that your own shop's expectations for the S&P 500 are that it will be ultimately higher at the end of the year than where it is today. But I've had so many people recently that have just been cautioning, based on some Septembers of yesteryear and all that other kind of stuff, that there could be some choppiness in the market in the short term. Would it be your view that we end the year higher and that you should equally not be surprised if things, get a little interesting in the interim?
Yeah, I think that's the storyline for us. When we raised our target, a week or so ago, it was like, okay, great, we're giving you another, 3-4% upside to the end of the year. That's 4.5 months. But we were very clear. We went into this year expecting volatility to be sort of an ongoing message in terms of navigating the markets shorter term. And and that's even heightened given the move we've had, particularly in the NASDAQ. So the messaging has been, expect volatility, expect shorter term swings, and given where we are in terms of our fair value assessment for the market, 6,600 end of this year, 6,900 mid next year, we want to be opportunistic on these pullbacks. And what we're saying is that the fundamental broadening led by the mega cap growth tech side that potentially goes down to other sectors, that all is something that we feel very confident in, such that when you do get these pullbacks, we want to be positioned to be, using those opportunistically from a longer-term structural perspective.
Okay, really helpful. Before I let you go, because you guys do a lot of number crunching around earnings and profit, and you alluded to some of that earlier, how would you characterize the earnings that we're getting? We just got largely through an earnings stretch where most companies beat expectations. I've seen a lot of estimates on Wall Street coming up for the current quarter. I think a lot of people were wondering about how the tariff story would impact profits. We've heard a lot of stories about companies that are eating some of that tariff cost in the short term. But when it comes to the actual profits, because there's a number of ways for companies to get there to bottom line performance that beats expectations, what's the quality of the earnings, which does matter when it comes to valuations?
Yeah, it really does. I mean, you look at the quality of the earnings, what I think we got with the Q2 results was strong sales performance, which is high quality. That's what really we're kind of focused on here. That led to a pretty impressive upside surprise with Q2. That had us lifting our full year S&P targets for earnings up to 272 in index earnings from a previous 261. Now, it's really important here, John, to keep some perspective to your point. We've been saying for some time that tariffs are probably going to be a margin headwind for many U.S. companies, right? Now, what we've gotten with the budget bill that was passed recently is some relief on the other side from a tax effect perspective. Lower tax-driven earnings are not as high quality from my perspective. You don't pay as high of a multiple for that. But what we are seeing is a continuation of fairly solid sales trends. But as you're talking about earlier in the program this morning on the consumer side, we've been laying out consumer discretionary for several months as that hot button, that real focus point for where tariffs should begin to have an impact. So as we're looking at these reports, that's what we're trying to gauge. Our view has been that there probably isn't enough underlying consumer strength to allow a lot of the tariffs to be pushed through to higher prices. Our view is that it's more of a margin pressure issue. So that's what we're looking at with these reports. How much of the margin pressure is a function of the consumer in aggregate, tariff influences at impacting costs, and what are companies doing to remediate that? And so what you're finding is that companies aren't standing still. They're adjusting supply chains, their business mix, so on and so forth. So what I think we're looking at here is, as time passes, we're pushing these tariff concerns not completely out of the way, but into the background versus other more traditional metrics that are coming into play.
Helpful. And then that other piece you talked about, even if you'd prefer for earnings not to be influenced by, tax changes, that is, I mean, we really have been talking about the consumer more so than the big beautiful bill, but that is a consideration as you're looking at earnings over the next few quarters. Scott, really helpful perspective. Thanks very much for joining us. Appreciate your time. Scott Chronert is U.S. equity strategist at Citi.